Good afternoon, everyone. Welcome back to Profit Matters. My name is Steve Abernathy. I'm the Chief Financial Officer for the World Floor Covering Association. It's good to have everybody with us this afternoon. I know more will be joining us shortly, and others will be watching later on the recording. But it's great to have you this afternoon. If you got any questions during the presentation, as always, please submit those through the chat on the Zoom call and/or send us an email through our website. And we'll be try our best to answer those questions either now or later on as time allows. Again, welcome back. This is our third installment of Profit Matters. Again, part of our Studio 59 program here at the World Floor Covering Association. Today's session, we're going to talk about sales compensation models and their impact on gross margins. In our last session, we had a couple of questions that followed up from the presentation when I mentioned the fact that sales compensation models can greatly impact your gross margin. And I talked about there's various sales compensation models that you can use. There's probably 100 different variants of different sales models that people use throughout the country, not only in this industry, but across other industries as well. We're going to look at a few of those today and really examine how they work, when you should use them, what are the pros of those sales compensation models, what are the cons, and how do they relate to the gross profit margins of your business. So that's kind of some of the topics we're going to look at today. So as we dive into the slides, there's some first key considerations I want us to look at. Basically, number one is, the point is recruitment and retention is becoming increasingly important in our businesses. I think everyone will agree that we're in a very difficult time due to COVID, due to the labor shortage, due to the supply chain issues that we have. Labor is in high demand, and more people are retiring. You're probably getting a lot of seasoned sales staff that are retiring. That is impacting our ability to recruit and, even more importantly, to retain high quality salespeople. So when we start talking about today, these compensation models, we're going to take that recruiting and retention into consideration and looking at the various models, because it's a big factor in addition just to gross margins. We're going to look beyond gross margins, just look at some of the impacts that these models have on other elements of running your business. The second thing I want us to look at is and understand is that your compensation model drives behavior. So if your salespeople are incentivized to a certain behavior, they're going to act in that way. And so that's an important consideration when you're choosing a sales compensation model, is how do you want them to behave or act, or what do you want them to do? So keep that in mind also. And then in terms of gross margin, the sales compensation model really only impacts your gross margin if you allow your sales staff to negotiate prices on the products and services. That's a key factor in each of these models, is do you allow the salespeople to negotiate pricing? If you don't allow them to negotiate pricing, you just publish the price and they're expected to sell those products and those installation services, for example, at the prices that you as the business owner publish, then you're really not going to drive gross margin change through your sales compensation model, because they're not really responsible for setting the price. You are, or the business owner is, or maybe your sales management is, whatever it may be. So as we look at these and I start to talk about gross margin impact, realizing that I'm making the assumption here in our analysis that they can negotiate prices on products and services, which is probably the norm, I would say, particularly when it gets into things outside of just pure retail. So your builder business, your negotiated business, those types of things are typically, set variable based on the size of the job, a lot of other factors that can come into that. So understand that is one of the considerations that we're looking at today. And the question is also, as we get down to a couple of these models, is do you want your sales staff to see your product cost? Do you expose that to them, or do you not expose that to them? When we start talking about commission on profits, for example, that's a consideration. So keep those in mind as we go down through it. We'll start and just dive in. I want to go through these and talk about each one without any further delay on my part and just examine the various models. The first one we're going to look at is the salary only model. And then we're going to look at salary plus a discretionary annual bonus. This is an annual bonus, not a commission. Difference in the two. And then we're going to look at the straight commission on sales model, very popular model undoubtedly. And then we're going to look at the base salary plus commission on sales, base salary plus commission on profits, and a sliding scale, which is a bit of a hybrid, commission on price point of the product that is sold. So those are going to be the things that we look at in the various models. As I said, there's 100 models out there that you could look at, but we're going to only focus on, these 6 for today, just for time, number one. Number two is, these are some of the more common things that you might see in our industry, or you might be competing with in trying to recruit salespeople for your business. So first off, let's look at the salary only model. When do you use this model? What is it? First of all, well, it's pretty straightforward. You're going to pay your salespeople a fixed salary, or dollars per hour if you pay them by the hour, which you might do. Particularly if they're not managing anyone, you might just pay them $1 per hour to man the store, for example. So it may not be a salary per se, but it could be $1 per hour. But nevertheless, it is a fixed straight dollar amount that is not impacted at all by how many dollars of goods they sell or what margin they sell it at. When do you use this? Well, this is ideal for companies when sales rep retention is critical. You really want to make sure you keep someone staffed there all the time. You don't want them to go somewhere else because somebody offered them, some enticement to come away from you. You're giving them stability, and stability is very important to that person. That's the type of model this works in. The company is actively investing in that employee as a salaried individual, and they really want to present to the consumer, to their customer, they want to present this no pressure shopping experience, so that there's no pressure on the salesperson to either drive higher sales or higher profits. They simply are being paid for their expertise and time, and there's no real driver or incentive there for them to pressure that consumer or that customer into selling. Now, that's a good and a bad thing, obviously. That may be the model that you've set your store up. It may be part of your brand experience, that you have a no pressure model. I mean, a lot of car dealerships have gone to that. And over the last few years, they were really promoting that heavily until kind of everybody went to it, because consumers just hated to go into a car dealership and get pressured to buy and close right now. And there's a lot of resistance to that from the consumer, that pressure, high pressure, pressure cooker, they say, kind of model. And so consumers push back. So some people use this to say, hey, we don't pay our salesmen on a commission. We simply pay them a salary, and they're in it to consult with you and be your, to be your best friend in this buying process, to help you through the buying process without any pressure, without any incentive on their part to try to close you on something that you really don't want. That's a good thing from a consumer, from a customer experience. However, in this model, if you use this model, you really need to incorporate price negotiation limits. Either not allow your salespeople to negotiate pricing at all, or set some parameters on their negotiating ability so that they don't give away margin. Why? Because, well, the pros is you get better employee retention. You fix your cost, labor cost of sales in dollar terms. You know what your salesman salaries are going to be at the start of the year. It's going to be X amount of dollars for X amount of people and X amount of hours and so forth. You know what that is up front. It's not variable at all. So those are the pros to it. The negatives are there's no incentive to achieve higher sales growth or higher profits. And it creates a widely variable selling cost as a percent of sales dollars, because your dollars of labor is fixed. Your sales are going to vary. Therefore, your percent of sales for selling expense is going to vary quite greatly and quite widely. So it doesn't give you as good of an ability to to plan in percentage terms your expenses relative to your sales dollars, although it does give you really good ability to plan your expense part of that. Now, what is the impact to gross margin on that model? Well, it can significantly impact your gross margins if you allow them full flexibility to negotiate price. Once again, as I said, you've got to put some parameters on their ability to negotiate selling price for both your products and your services. Otherwise, they may simply give away, the farm, so to speak, because they're not incentivized. And they may also become lazy. I didn't mention that point too, that they are not really pushing or trying to sell the product. So you may see top line fall. And if you allow them to negotiate prices, you may also see bottom line fall. So there's some downsides to that model. There's certainly some upsides on the customer service side of it, but that's a model that some people use and some people use it very effectively. Now, a little bit of a twist on that, the second one I want to look at is the salary plus discretionary bonus model. This model is very, very similar, has the same objectives. It's you want to retain your salespeople. You want to present this no pressure shopping experience to your customer, but you want to give them some incentive to participate in the success of the organization. Once again, you should set limits there to how that pricing negotiation is allowed. You shouldn't allow them just full flexibility on negotiating pricing. But this discretionary bonus can be done a couple different ways. Number one, it's a pro in that it helps employee retention. They understand what they're going to make. They don't like the variability. They like the stability of this model. So that helps a lot on employee retention. The flexible bonus criteria is on an individual basis or on a company basis. You can calculate their bonus either on our overall company sales growth or targets, or individual sales targets, or individual or company profits. You can do it one of two ways. So you can let that employee share in the sales growth or sales metrics of the organization, their individual sales metrics, or you can do the same thing on profits, one way or the other. You've got flexibility in this model to do the bonus at your discretion any way that you see fit. And the bonus does offer, as I said, some incentive for higher performance achievement, both on sales and bonus, depending on how you set it up. The negatives on this, though, is the incentives are minimal, really, for higher sales growths, because the bonus is typically not going to be a huge percentage of their overall compensation. It may be 10% of their overall compensation. It may be 5% of their overall compensation, which is sort of typical for maybe salespeople in this way. The bonus is often vague at the start of the year. It's very hard to track until you get down to year end. You really don't know as a salesperson what you're going to make or how it's going to impact your compensation. So again, those incentives are really minimal in this model, but it does give them the ability to participate, and it does give some incentive and aligns their objectives with whatever your objective priorities are for the business as a whole. Impact to gross margins, once again, without parameters on pricing, if you allow them to negotiate pricing, this could significantly impact your gross margins and as well as your top line. So those are two that are really centered around this base salary with no commission in the structure at all. It's not based on a commission per se, but it's a bonus and/or one without a bonus. Now, the third one is a pretty common one in some industries. Insurance is a good example of this. Insurance, you've heard of insurance salesmen. I don't know if they're higher or lower on the totem pole than flooring salespeople, but probably lower on the totem pole. At least you got that going for you. But straight commission on sales. This is basically where you have no base salary. You're just paying a straight commission on sales. And there's a lot of pros to this and there's a lot of cons to it. By the way, there's a twist to this. You can have it with or without a draw, meaning that you can set it up as a draw plus, calculate the commissions and the draw is going toward the earnings on commissions. Or you could do it as a straight commission, don't pay any draw. But the draw seems to help stabilize some of their income, which helps a little bit on the retention side of it. When do you use this one? Well, this is usually leveraged by startup organizations or other businesses where they might not have enough capital to fund, a team of salespeople early on. In particular, these startups might not have. They're waiting to build an asset base, because if you do some sort of a base salary for a sales staff, you've got to be able to fund that through capital until sales kick in. And so for startup businesses, this works really good, because essentially there is no pay if there is no sales. So that's where this works really, really good. As I said, it can be executed as a draw on the earned commissions. That's one way to do it and stabilize some of that income for them. Of course, if they don't meet their draw amount through commission earnings, you have to deduct that, and that can be negative if it's done. Once again, in this model, you need to incorporate price negotiation limits if you allow them to negotiate pricing. What are the pros here? Well, it's great for high performing sales staff that really want to drive no top end, essentially, in their earnings power. So it's great for those high performing salespeople. They can really make this work for them. And it fixes your labor cost in terms of, in percentage terms, as a percent of sales dollars. It fixes that. So if you know you're going to pay 10%, let's say, commission on sales, that's what your cost is going to be, 10%. There's no base salary to calculate in there. As the sales vary, the 10% is going to stay the same. It's real easy to fix that and know what that's going to be in terms of looking at your sales percentage of cost, or cost percentage of sales, I should say. It's the highest model for incentivizing top line revenue. No doubt about it. It will drive top line revenue better than any other model will. It's easily trackable by the staff. They know if they sell, $100,000 worth of goods and they are on a 10% sales commission model, they're going to make $10,000. And it's just a real straight, easy calculation for them to track. It's not complicated as maybe some of these next few are. And as I said, it's a pay-as-you-go plan. If you don't have any sales, you don't have any costs. So for a startup business or businesses that have low amounts of capital to run their organization, this model works really, really well. And a lot of people use it. A lot of people in the flooring business use it. But it is oftentimes, though, the negatives is recruitment and retention, particularly in downtimes. You're likely to lose a lot of salespeople when times get slow. Why? Because they're not going to earn anything, number one, and they're going to go find an industry they can earn in. So this model is terrible when it comes to employee retention in down times. Now, in good times, you can keep them all day long. They can earn a lot of money. In fact, I've seen these models where the salespeople earn more than the owners, earn more than their managers that are on salary. So these are boom and bust type of situations. And so when it's booming, you don't have any problem getting folks. But when the bust comes, very difficult to keep them. So keep that in mind in this particular model. The gross margin can and will and often is sacrificed for commission. If you allow them to negotiate pricing and they're on a straight commission model, and you don't put a floor in how low they can go, they will gravitate to the lowest price they can get to in most cases, because they are trying to close the sale. They're paid on sales, not on profits in this model. So you're going to sacrifice gross margins. In all of the models, this is the most critical model here, where you have to set limits on price negotiation. If you don't, it'll destroy your margins. As I said, it can greatly impact or even destroy those gross margins. This is the straight commission on sales with or without draw. Now, the most popular and the most prevalent model that you see is the following. It's the base salary plus a commission on sales. This is a hybrid of just a straight salary and or a straight commission. This is somewhere in between. When do you use this? This structure is ideal for companies where sales retention is critical to the success of the organization, and the company is invested in the success of this employee while incentivizing their performance. So this is a hybrid. This gives you stability, but it also gives incentives to that sales rep in terms of performance, and it drives sales. The standard ratio, and oftentimes you might get asked, or I might get asked, what is the standard ratio of that? Across all industries, it seems that, based on my research, the norm is about 60-40. The ratio is, meaning 60% of total compensation is salary related and about 40% is commission. Now that can vary by industry significantly. I mean, it can be 75-25, it can be 50-50, but in terms of just average norms, what seems to be prevalent is about a 60-40 split, at least from my experience. You may have different ways that you deploy that. Certainly let us know in the comments if you do, but that's what we generally see. Once again here, when you're paying a commission on sales, you've got to have those limits on price negotiation, even this model. They're less, to a lesser extent, important here because only, let's say you set up a 60-40 split, only 40% of your sales compensation is affected by this. So it's not like you're directly exposed, but certainly you still are exposed to the issue of salespeople giving away, giving away margin if they're allowed to negotiate the selling price in order for them to gain commission, because still 40% of their earnings power comes from commissions in this model. The pros to it, though, it's the most conventional and popular model for sales compensation. Everybody understands that model. They're used to that model. It's used very widely across a lot of different industries. Employee recruitment and retention is still very good in this model, but it does provide good incentive to achieve higher top line revenue. And again, it's easily trackable by the staff. They know what their base is. They know what percentage they're making off of commission. So they take their sales dollars times that percentage. It's easy to calculate what they're going to make. The negatives to it is gross margin, again, can be sacrificed for those higher commission dollars on sales. And you, again, have a somewhat variable, sales cost as a percent of sales dollars, selling cost as a percent of sales dollars in this model. Not so much as it is in the base, just straight base salary or the salary plus bonus, but certainly it's still impacted there by the 40% that's variable, or the 60% that's fixed in that case. The impact to gross margins, we talked about already. If you don't define the limits, this can impact gross margins negatively by them giving away margin in order to get the sales. Now, there's another model similar to that, but instead of paying on sales the commission, you pay on profits the commission. Now, this model is a little more difficult, but essentially what this is it has similar objectives. You use it when, again, you want to retain those employees because they've got that base salary built in, you've got good retention, but you're also, and you're investing in that employee, but you're also wanting to optimize gross margin for the company. This is a model where you take the focus off of just strictly sales and you put it on profitability. And that aligns oftentimes with the objectives of most organizations. They're trying to maximize profitability. Now, you may be trying to grow sales and build your market share and things like that. The objectives of your business drive a lot of these models. But if you're an established organization and an established business where you've saturated your market to some degree, you really want to focus on maximizing the profit potential in the sales that you already have. And so this model works very well on incentivizing that objective. The standard salary to commission rate, again, is about that 60-40 split. That really doesn't change there. It's just a different way of calculating it. However, in this one consideration is you're going to expose the cost of your product to your sales force. So that's an important consideration. Do you want to do that? Do you want to allow your sales force to know what your profit margin is? Because this is going to be part of that. If you allow them to get paid on profit in order for them to calculate what their earnings would be and to verify their earnings, they're going to have to know what the cost is, what the profit is on that sale. So that is one consideration. You may not want to do that. So this model certainly causes you to have to do that and maybe ruled out for that reason. The pros of it, though, it's a hybrid of the conventional and popular base plus commission model that we just talked about. Everybody understands that model. The employee retention recruitment is good, just as good probably as it is on the preceding one, and it provides good incentive to achieve higher gross margins. It will drive gross margins higher because they are incentivized on the profit side of it. They're going to be less willing and less apt to negotiate lower pricing when they're compensated based on the higher margins. So this will drive your gross margins up if you can set this model up. Now, there are some key negatives of this model. Number one is some sales loss you may experience if pricing becomes a sticking point for the consumer. If consumer really is a hard negotiator, really wants to see, you start up here and land here on pricing, start high, end low. Well, your salespeople are not incentivized in that way. They're incentivized to start high and stay high with this model. So they may not be readily so eager to negotiate price, and you may lose some sales that way, because oftentimes consumers walk in, and some of them, have this personality, kind of like me, I suppose, that wants to negotiate everything. When I grew up, my dad was a shrewd negotiator of pricing. I'll tell you a little bit of a story. I was about 7, 8 years old, somewhere in that neighborhood. I remember this all the way back to then. We go into Walmart, a Walmart store. This is a national chain, of course. We go into Walmart, and I'm getting a bicycle. It's my birthday. He wants to go in and buy me a bicycle. We go into the store. And I kid you not, we got out of that store. By the time we got out of that store, the manager of that store was ready for us to leave. He negotiated the price of the bicycle with Walmart. So I learned from a master on price negotiation. There are some customers that are just like that. They want to negotiate everything. And so, when you have this model that incentivizes solely on profits, which is a business objective, then you may have customers that don't respond to that so well. So you may lose some sales dollars in this particular model. It is certainly more complicated to set up, to understand it, to calculate it and track it, because you're dealing with not only sales dollars, but cost dollars that come into the equation, and you're trying to figure out what that difference is on every job so that you can pay your salespeople appropriately. Now, I would also tell you that in order to handle that negative, you really would need a software package that handles that for you. So if you've got one of the large, flooring specific software packages, most of them would be able to handle this, pretty seamlessly. Basically, what you have is what the costs are for your products and labor that go into a particular job. What the selling price is on that job. It's real easy to calculate electronically through your system the margin on that job that's assigned to a particular salesperson. So you should be able to produce reports that give you that information so that you can make payroll. But if you're having to do this manually, this would be very difficult, if not impossible, to execute. But if you do have an automated system, this will drive your margins higher, which is your profitability. It'll fall right to the bottom line, because gross margins ultimately fall right down to the bottom line. And in the converse of the other models, this can significantly improve your margins and profitability, not be detrimental. All the other models that we looked at were detrimental, or could be detrimental to your gross margins. This can actually impact positively your gross profit. All right, the last one I'm going to look at is this idea. It's, again, a little bit of a hybrid of what we just saw there. But it's the base salary plus a sliding scale commission on price point. I know you can't probably see that with my face over the screen, but that's what it says. Sliding scale commission on price point. When do you use it? What does it look like? Well, first of all, this again is you're focused on retention of the employees, recruiting and retention. That base salary comes into play there. And you're wanting to optimize the margin on sales, just like in the previous model. You're trying to make that gross profit go up, that gross margin go up. Once again, the standard ratio here on these base plus commission models is about 60-40, regardless of how they're executed. The pros of this are that it's a hybrid of the conventional and popular base plus commission model. The employee retention and recruitment is good. It provides good incentive for higher margins. Because why? Because the way you set this up, and I'll talk a little bit about how we set this up in a moment, but it is a sliding scale. So higher price points equals higher margins equals higher commission, because it's a sliding scale. This model is very, very similar to paying the base salary plus commission on profits, except you don't have to expose your cost. You're not actually calculating margin on every single job in that manner, but what you're doing is you're setting price points, and there are different commissions earned based on the price point that they sell that product at. It is certainly very difficult to understand and to calculate compared to these other models. So for example, let me give you a little bit of an example of how that might work. So let me do it this way. Let me go to the board and let me see if I can draw it out for you. That might be the best way to do it. Okay, so in this model, if you have a product that costs you $10 a yard, carpet product that costs you $10 a yard is cost. And I'm just going to use product. I'm not going to bring labor into this at the moment. Certainly you would bring labor into this model as well. And you want to sell this product at $20 is the selling price. I'm going to use this so that I can do the math in my head. So you got a profit, right, on this of $10, and $10 divided by 20 is 0.5, which is a 50% margin. All right, that's a really good margin, probably not norm, but certainly a good margin. So let's say that your standard margin or your target margin was 50%. Maybe you calculate this and set this price where that margin is 40%. Let's say you're in retail, you're shooting for a 40% margin on that product. So one of the ways you can set up a sliding scale commission structure is you can take this and you can say, okay, my target is 50% margin, which is a $20 selling price on that product. So if I sell that, and you can set this up on a spreadsheet, some of the software companies' software may be able to do this. But what you do is you say, okay, if my commission on the sale in this particular case is going to be, if they sell it at $20, I'm going to pay them 5%, let's just say. If they sell it below $20, but above, $19.50, let's just say, I'm going to pay them 4% of the sale. If they sell it for, below $19.50, but above $19, I'm going to pay them 3%, et cetera, all the way down to where I'm going to set a floor and pay them nothing on that sale. That is a sliding scale model based on price point of the product. You pay a variable commission rate based on the price negotiation that you allow them to do. This does not expose cost to the salespeople, but it gives them price negotiating flexibility while varying the commission, incentivizing the higher sales price through a lower commission amount. And this directly ties to gross margin. As you can see, if you sell it here, your gross margin is different than if you sell it here. It's lower, lower, and lower, lower. So you earn a higher commission the higher you sell it at, which is the higher gross margin. And this works like, paying a base plus commission on profits without having to expose the profit side of it or expose that at all or calculate that every time you do a sale. What you can do is create a price list. You could actually convert these into percentages if you wanted to. Instead of setting these price points, you could set it at percentages. You can say that the standard selling price for this product is 20. Maybe that's the way you price the floor. And if they sell it for, 95% of that, they get, if they sell it for 100% of that, they get 5%. If they sell it for 95%, they get 4%, et cetera, et cetera, et cetera. You can convert it into percentage terms. Then you don't have to set these individual price points. You can simply let them calculate their percentage of the floor, marked price. That's another way to do that particular model. Once again, those are a little more complicated. But they achieve what you're really trying to achieve oftentimes, which is drive that margin higher. And again, without exposing price or going into those complicated models of that. All right. So that again is the impact to gross margin. It can significantly improve your gross margins and your profitability because either one of these last two are focused on driving margin. And you're aligning the model to the behavior you're trying to incentivize, which is driving your business objectives. If your business objective is to drive gross margin. Again, early on in a business, you see this oftentimes, the objective is different than when it is in a mature business. In a business that's just getting started, it may be that the objective here is to drive sales, and sales is certainly very important to establish. You need to establish a customer base, particularly in situations where the customer is going to be a repeat customer, builder business or commercial business or, Main Street business, those types of things. So it's very, very important to look at what your business objectives are before you set these models up, because if your business is to drive sales, then don't set up one that's based on margin. Set some reasonable parameters and give them some flexibility to go after the business. But when your business matures and you've got a large customer base you're trying to maximize profits out of, the shift toward, the focus on profit margins will help your business get much, much more profitable and throw out much more benefits to you as an owner once you mature and get these types of focuses with your sales force. All right. So let me look at now some examples from our business intelligence tool. I want to look at some of the data that we have out there. And I pulled this for the last year, ending in September 30th of 2021. So this goes all the way back from October 1st of 2020 to September 30th of 2021. The reason I did that is because the data lags a bit coming in, and I wanted to get a full 12 months. So this is a full 12-month snapshot year over year. So this is through 2021 versus through 2020 of the prior year. And what this is this looks at our entire database, again, of over 1,000 businesses out there. And it looks at the total average dollars per salesperson. And as you can see here, the number on the far left side on the screen, this number, if you can, I don't know if you can see that number. Yeah, the one on the far left side is just over $1 million, $1.021 million. So if you look at our database of data, all the stores we have, and this includes a broad swath of businesses. So this is not just retail, not just commercial, this is across the board. It's about $1 million. Of course, it's going to be highly skewed if you're in the builder business, because the builder business is, let me get to a different slide here. I think I can maybe show you this straight off the screen. It might make more sense. Yeah, here we go. So this is the builder side of it here. If you look at this past year, the past 12 months, that number is almost 2 million. You're not seeing that? I'm sorry. Let me make sure I can get this. Well, you can't see it. It's on the far left side. The blue graph, the blue line on the graph, far left graph, is, and I know you can't see it. That's what Lewis was telling me here. But nevertheless, let me just give you the numbers. From the builder perspective, that number is almost 2 million, almost $2 million worth. So the average sales per salesperson is about $2 million on the business side of it. On the commercial side, which is the next graph, that number is about 990,000. On the Main Street commercial, it's about 1.1 million. On multifamily, it is 1.7 million. And in the retail side, it drops way down. It's 630,000. Why is that? Well, it's pretty common sense. On the retail side, you've got to basically you got to cover the store hours. So there's a lot of retail sales time that's spent sitting in the store waiting for customers to come in. Whereas if you're doing builder business, you're out and about and you're calling on customers on a continual basis. It's much different than it is in the retail model. So sometimes the focus of your business will need to determine what sales model, compensation model that you use. But the average sales per salesperson here is about 630,000 on the retail side of it. On the wholesale side, it's about 1.4 million. So when you look at that in dollar terms, again, that $1 million mark that we showed you on the top left up there, that is across the board in all of those segments. The next number is the average sales per salesperson in the prior year. So we had $946,877 in the prior 12 months. That was an almost 8% gain on average across the board year over year. So we saw a really nice move from let's say 2020 into 2021, or almost an 8% increase. The next, the right side of that screen shows you the gross profit, average gross profit per salesperson. And across the board, once again, that number looks at about 341. And if you take that number and divide it by 1.21 million, what do you get? You get just a little over 30% gross profits, which is some of the numbers I showed you in the prior sessions. And prior year, it was 314,000. We saw an 8.83% increase in gross profit dollar average per salesperson year over year. So we had a 7.8%, 7.9% growth in sales per person, but an 8.83% growth per person in the gross profit side of it. So you can see as the gross margins was going up at a higher rate than the sales were, and that's a good thing. So we had either some pricing power there, year over year change, which I imagine that we did, and that has helped us. In fact, a lot of folks are concerned, oftentimes get concerned. I may have said this in one of the last sessions. A lot of times we get really focused on, you know, the increases in pricing. We get all concerned about that. It's going to impact our business. Most of the time, it probably impacts you positively, because you're passing that on to your customers. And if you maintain, you know, a 35% average gross margin on higher dollars of sales, you're going to make more gross profit dollars. So that's a real important thing to note, that price increases are not always negative. Someone asked me to repeat what I just said about gross margin increase. The gross margin increase went up by 8.83%. Gross margin dollars, not percentage. Gross margin dollars increased for the average salesperson 8.83% year over year, 21 to 20, based on our data from an overall perspective, while sales only increased 7.85%. So you had a higher increase in your gross margin dollars than you had in your sales. That means you're making more gross dollars per dollar of sale, which is a good thing. Once again, I think I'm attributing that probably to the price increases that we're seeing. You've been able to pass along price increases, probably, you know, again, if you're keeping your margin calculations the same, you're getting more dollars just by nature of the fact that you're selling more at a higher, you're selling the same at a higher rate. In fact, you may be selling more at a higher rate. So it's helping you. Price increases don't always hurt you in any way. If you look again at just pure retail on the gross profit per salesperson, you're looking at roughly 235,000 on the gross profit for the retail sector. Wholesale is about $406,000 average gross profit per salesperson. Multifamily is $483,000. Main Street commercial is $386,000. Commercial business is $306,000 gross profit per salesperson on average, and builder is $595,000. Much more profit there on the builder side of it per average salesperson. So those profit numbers that I just quoted, and by the way, if you go back and watch the video, you can jot those down. I'm also going to include, of course, these slides as we post this on our website. But those numbers can be used to compare to your business. How are you doing? You know, what are your average salesperson? You know, how many dollars of sales do they average for the last year? How much dollars in gross profit, if you're tracking that? How much did they generate on those sales? Those numbers are very important, particularly when you start to look at how much you're paying those people for generating that sales and or that gross profit. Let me just show you also then sort of an average here of, let me get back to the PowerPoint slide if I may here. Let me see where that's at. Okay. I believe that went back to there. Yeah. So let me talk a little bit about some of the norms out there in terms of sales compensation. I know we've been talking a lot about sales models, but how much do you pay a salesperson? And it varies quite widely by industry. So I did some research and found some data for various industries. Unfortunately, I don't have access to in our BI tool, nor do nor could I find specific sales compensation for the flooring industry that I could share with you. However, there was data that I can for other industries, and we can get sort of a comparison as to what the norm is. This is 2021 data. So as you know, salaries and wages have been increasing for most employees in most businesses just due to inflation. That is likely to continue as we look out into at least the near future, and maybe even longer. But what are those salaries? Well, the data that I found showed that in the wholesale and manufacturing industries, sales reps make on average about $61,660. This is average. You may have some that make $30,000. You may have some that make $90,000 or $100,000 over six figures. But the average, the mean, is $61,660. For insurance salespeople, that's $50,600, significantly lower than that. For advertising sales agents, $51,700. For real estate brokers and sales agents, $50,000. In the financial sector, it's about $64,000 for selling financial services, securities, and commodities. Door-to-door salespeople, news and street vendors, and those types of related workers are way down there at $26,000, and sales and related workers in all other categories average about $33,000. So if we were to look, say, at manufacturing and wholesale sales reps, which is probably the closest aligned to our industry, that 61,000 probably represents a reasonable target as to what an average salesperson might make in the flooring business. Again, I don't have access to that real data. Certainly, take this with a grain of salt, use it for what it is, which is just another industry's data. I wished I could find some information, and maybe we could survey and find that out. I'd love to have that piece of information and know what you're paying. And these 1,000 businesses that we have data on, what are they paying for their average salespeople? But I thought I would share those metrics with you, both from our BI tool, business intelligence tool, as well as the research that I was able to come up with to compare it against our industry. Now, one of the things I want to do is I want to give you just a couple of little formula calculations that you can use to analyze and or calculate, what it is, when you're setting up these compensation models. What do you use? If you're going to pay a commission, for example, as a part of compensation on sales, how do you set that commission rate? And then if you're going to pay that on margin dollars, profits, how do you set that rate? So rather than put it on the board, I think I'm going to use my Excel spreadsheet. I built an Excel spreadsheet, and hopefully it'll pop over here in a minute to you. Let me see. On my screen, it's not on yours. You don't see it? Okay. Let me see here. If I can get it to show up. No, it's not showing up. Having some technical glitches here. I may have to do it on the board. I tell you what, since it's not showing up on my screen, I'm going to go ahead. Well, wait a minute, let me check something. I'd really like for you to see this on the screen. It's a little clearer. Okay, here we go. Okay, let's try it that way. There we go. Okay, got it. Sorry about that. So one of the things I wanted you to look at is I built a spreadsheet here. Let me just straighten it out here where you can see it to help you kind of work through this. I'm going to let you see it, number one, so that you can understand how it's done. But number two, I'm going to share this file with you, and you can use this template here in your business to try to do some what if scenarios, because this is kind of a what if scenario spreadsheet. On the left side here in this section over here, I've set it up to look at setting your commission percentage as a percent of sales. So this is set up as a model for the situation where you're going to pay a base commission or base salary plus a commission on sales dollars. That's what this first template is about on the left-hand side. On the right, it's the same thing, except it's based on profit dollars. So two different models here, and I've got it set up to do some what-if scenarios on that. So how did I do it? Well, first off, I said, let's set up a target compensation for a salesperson. What is my target total compensation for that salesperson? If I want to pay $63,000, I just picked a number here. It was close to the 61 that we saw in the manufacturers up there. I picked $63,000 and said, we want to target our average sales compensation to be $63,000. And we want to target the sales for that person at $630,000. Remember those numbers that I showed you on the benchmark tools? That is where I got that. So this is more of a retail business where I'm paying a base salary plus commission. The average salesperson is doing about $630,000. And I want to pay them, $63,000. By the way, what does that equate to? That equates to 10% of sales, right? So in this particular what if scenario, I am targeting a 10% sales compensation model, not including benefits. I could certainly put maybe the 63,000 includes benefits, who knows? But certainly a 10% cost of sales for sales commissions as a percentage of the sales dollars. So if I take the split, by the way, these things in green, when you get the template, if you download the template, the ones in green are what you change. Those are the variables. So I'm going to set up a 60-40 split between salary and commission, which I did here, as you can see. So what it does is it calculates what 60% of the $63,000 are. Basically, it's 0.6 times 63,000, which is $37,800. That's how much you would pay them in a base salary if you want to execute this model. And then on the commission side of it, that commission, which would be 40% of 63,000, is $25,200. And so if you want to pay $25,200 in commission on $630,000 of sales, it's a real simple calculation. You take 25.2 divided by 630 and you get 4%. So that's a real quick template. The formulas are already in there. You just change the items in green and it'll recalculate what you should set your commission at for a targeted average compensation and a targeted average sales per salesperson with a 60-40 or some other split in salary and commission. So real easy to change those numbers. If you want to change that to, I want to pay a $75,000 compensation, and I want to pay, I want to target $700,000 of sales. That's going to wind up being 10.7% cost of sales for my sales compensation. And I would set the commission rate at 4.3%. It's just a real quick and dirty kind of modeling template for you to calculate maybe what your target percent on sales would be based on a targeted selling cost. Now, on the profit side of it, it's very similar. You set the total compensation, the total sales per salesperson. I left it the same. In fact, I'm going to go ahead and I'm going to change these back. 63,630, and then I plugged in a gross margin. So let's say my target gross margin or my average gross margin, if I'm looking at averages, is 37%. That means I'm going to generate $233,100 of gross profit dollars. I'm going to split the commission 60-40 between salary and commission. So 37.8 here, 25.2 here. That didn't change. What did change, though, is the amount I need to pay on the profits of the jobs, not the sales dollars, but the profits based on that profit of $233,100. So you take the 25.2 divided by the 233.1 and you get 10.8% that you would pay on profits. So again, this is just a quick and dirty spreadsheet. I'll include this in the presentation that lets you do some modeling. If how much do I need to pay a salesperson and how much would I expect them based on, the flow of my business, what would I expect them, or maybe looking at your current averages and say, what are my current averages, and plug these numbers in and see if what you're paying on commission, works out to be what you're expecting it to be. And how does it, what is it as a total percent of your sales? If your gross margins on average are 35% and your selling expense is 10%, you're down to 25% left to pay all of your other expenses, your rent, your utilities, your taxes, your supplies, it goes on and on and on. I mean, think about it. You've got a lot of expenses to pay. That don't include your back office staff, all your other staff, paying the owners, all those things. So, it all comes from that sales dollars and, more importantly, that gross margin dollars. Everything sort of gets started at gross margin dollars and gets deducted. Sales expense is one of those, And it's probably one of the larger items if you run a sales force. Now, if you're just a small mom and pop operation that does your own sales, that's kind of where you get your salary. But if you hire a sales staff, you got a larger organization where you're able to hire a sales staff, this is very important because paying your sales commissions is a big chunk of business expense. And it also can greatly impact your margin if you set up your sales compensation model in the wrong way and you don't consider the things that we've talked about today. I'm out of time. I realize I'm going to stop right there. That's about all I've got today. Again, we'll include this PowerPoint presentation and this template in the post on the website. You're certainly welcome to go down there and download that. I'm going to break just for a second and ask Lewis, who's helping me produce these, if anyone has any questions. If you have any questions, certainly put them in the chat and or send us an email through our website, and we'll be happy to answer those later on. But if you got any right now, I've got about 5 more minutes. I could stay with you and answer any questions that you might have. I hope this has been helpful. I wanted to keep the focus today on this whole sales compensation piece, particularly as it relates to gross margin, because I got the question last week. Next session, we're probably going to go from there, and we're going to dive into all the expenses of a business. We haven't even got started on expenses other than sales expense. But we'll start looking at some of the other metrics and models on sales expense in the next session. And I hope you'll join me on that. I hope you all have a great holiday period coming up, great Christmas, New Year's, whatever you might celebrate, and enjoy that with your family. And if there are no other questions, I don't believe there is, we will see you after the first of the year. We'll get the next one scheduled, get it published, and you guys have a great rest of your day and holiday season. We'll see you then.